Next up, we have Joseph Wang, who, as I mentioned this morning, has a background working at the Federal Reserve on the Open Market Operations Desk. One of the places where you learn the most about how the current dollar system works. And he's here to talk to us about central banking and monetary policy. Joseph and I had a couple of conversations leading up to this where I basically just asked him a bunch of questions, things I was curious about from the perspective of Reserve, and he's going to do his best to touch on a bunch of topics that are relevant to those questions. So please join me in welcoming Joseph.
Hello, can you guys hear me? Yes. Well, first of all, thanks so much for inviting me, Nevin. It's a pleasure to be here. I was learning so much about everything Reserve related today and meeting a lot of great people. So as I've seen from the last presentation, you guys have a lot of work to do. So looking forward as to what the monetary system could be in the future, I thought it might be helpful to understand where we are today and maybe why we have the things we have today. So what I'll talk about a little bit today is just some basics about how the monetary system works today, imagining what would happen if we don't have a central bank, and a little bit of an update on the state of the dollar system, which, as we all know, is probably in some sort of decline. Okay, and like Nevin mentioned, my background is I used to work at the Fed. I was on the trading desk there. That's the desk where the Fed does things like quantitative easing, emergency loans, and so forth. But it's also a place where you can learn a lot about how the financial system functions. When you're at the open markets desk, you basically you talk to everyone in the financial system. We would talk to foreign central banks, we would talk to commercial banks, we would talk to hedge funds, and they would tell us, basically what they're thinking, what they're doing, because it was a confidential conversation. And of course, we also had access to a lot of data. So it was a really, really great place to have a peek behind the curtain. But as we began, I thought it would be really helpful to just have an understanding of the basics of the fiat system. So in the financial system, what you think of as money a lot of times depends on where you sit. If you are a commercial bank, what you think of as money is a deposit at the Federal Reserve. We call that reserves. But for most of us, though, what we think of as money is really a deposit at a commercial bank. These are bank deposits. There are tens of trillions of bank deposits in the financial system. Now, where do bank deposits come from? They are actually created out of thin air by a commercial bank. As I was just noted before, if you get a loan from JP Morgan, it's basically like a JP Morgan coin. So contrary to what people think, banks take in someone's deposits and lend them out, a good way to see how a bank actually creates a deposit is on this graph to the right. So on the right-hand side, on the bottom, you can see there's a balance sheet for commercial banks. A balance sheet is basically just a graph of what a bank owns and what it owes. Its assets are what it owns, its liabilities are what it owes. So before a commercial bank creates a loan, you can see it has, let's say, these reserves and assets, currency, assets and liabilities, deposits. Then, if I were to go to a commercial bank and ask for a loan of $1 million, what the commercial bank does is it really just goes into its database and it types in $1 million due to Joseph. It's created out of thin air. It's merely a database management question. So we call this expanding their balance sheet. And that is really where bank deposits come from. Now, this ability to create money is really an awesome power. So banks are highly, highly regulated. And of course, they do face very important business problems, specifically liquidity and credit risk. So if a bank made a loan to me and I failed to repay them, well, the owners of the bank are on the hook. So they have an incentive to manage that franchise well. And liquidity, of course, is, and we'll talk about both of these problems going forward, is that, as we all know, banks have short-dated liabilities, deposits. We can all ask for our money back anytime they want, but the bank might not necessarily have enough cash on hand to meet those withdrawals. That's a liquidity problem. And this also actually comes with a very interesting corollary, in that all fiat is basically asset-backed. So when we go and make a loan, for example, that loan, it backs the deposits that it's created. Now, one way you can think about this is that if you are if you go and get a mortgage, the deposits that are created, they're backed by real estate. If you go and get let's say a credit card loan, it's really backed by nothing more than your promise to repay. But that loan, it's an unsecured loan, but at the end of the day, that loan is still an asset that backs those deposits. That being said, though, the assets backing that vary in value over time. Now, on this chart here, we can see this, you might have seen this before, this is the amount of unrealized gains or losses on investment securities held in the commercial banking sector. Now, over the past few years, as we know, interest rates went up, and so a lot of the commercial banks had unrealized losses on their investment portfolio. So in a sense, the loans, their deposits might have been not fully backed, depending on how much equity they also had in the system. And there was one notable example of that, where many depositors didn't feel comfortable. So now going forward, one way to think about, so again, back to the question of a commercial bank having an incentive to create good loans. So here's an example of New York Community Bank, which was also in the news recently. So New York Community Bank is a very old, respectable organization who's been around for over 150 years. Now, they actually invested fairly responsibly, a lot of it in rent-controlled multifamily homes in New York City, and over the past decades has done really well. So it's not like they were engaged in wild speculation, but they did have a very concentrated portfolio in multifamily loans. And when New York City passed a law that made rent-controlled apartments less valuable by limiting how much you can raise rent, well, that really had a big impact on the value of their assets. And you can see here, it's their shareholders that have to pay that price, and it was quite of a steep price. So this is to show that commercial banks, while they have the power to create money, they are also incentivized to use that power wisely, because if they make loans that lose money, they are ultimately the people who bear the brunt, who bear the cost. That is their skin in the game. Now that we've kind of had the basics of how money creation and banking system work, let's talk about what it means. Well, let's talk about what the world would be like if we didn't actually have a central bank. Now, we can actually think about this because we haven't always had a central bank in the US, so we can look across time, but we can also look across the world as well, because there are countries where they don't have their own central bank, they outsource their monetary policy. Now, as we look at the central bank today, the most basic role of any central bank is to be a lender of last resort, and we'll talk a little bit about that. But secondly, though, central banks have also evolved to become very important in shaping economic policy. So in the US, a central bank has a dual mandate: full employment and price stability. So they have this tool, interest rates, and they try to set it to ensure that inflation is not too high, and that we have as low as unemployment, high employment as we can. And lastly, central banks have also, in some countries, taken on additional policy roles. In the European Union, for example, the ECB is quite famous for thinking that they want to help promote a more green environment. That's not the case in the US, but it could be the case depending on future administrations. But if we did not have a central bank, what I would emphasize is that all these functions, they would still occur, but they just wouldn't be done by the central bank. They would be done by other parties. So let's first talk a little bit about this lender of last resort function. So as we all know, commercial banks have a lot of deposits as short-dated liabilities that we can go and take our money out of a commercial bank anytime that we want. But they don't always have all the cash on hand to meet all those withdrawals. So let's say that everyone in this room rushed to our bank and asked for our money back. The bank could be totally sound, but the assets that it has, loans that mature over a number of years, cash comes in slowly. They don't have any cash on hand, even though maybe the loans are money good. Now, we had a good example of that just last year. This is the deposit outflows during Silicon Valley Bank. You can see here, in that period, the super regionals and the large banks had several $100 billion worth of deposit withdrawals basically in a very short period of time. It's very, very unlikely that banks had enough cash on hand to meet just the hundreds of billions of dollars of withdrawal. And so when that happens, they go to the Fed, the central bank, and they say, hey, we have all these assets and our money good, we just don't have cash on hand. Can you spot us some liquidity? And which is what the Fed did through many mechanisms. One of the new ones here is something called a Bank Term Funding Program, BTFP, and there the Fed made emergency loans of over $100 billion to try to act as lender of last resort, providing liquidity to the commercial banks. Again, these loans are fine. It's not a solvency problem. It's just that the banks don't have cash at the moment. So by being lender of last resort, the Fed is able, and other central banks are able to stabilize the markets and instill confidence. And it did work. After all, we had Silicon Valley Bank go down, but the other regional banks, by and large, calmed down, and that banking crisis passed. But there was also a time when we didn't have the Fed. And what happened then? Now, banking panics have been happening since we've had commercial banks. This is the panic of 1913. Back then, there was a company called I believe it's the United Copper Company, something of that. There were a small group of speculators who were trying to corner that company by buying up all the shares. When you buy up all the shares, you basically be able to set the price. But they were not successful, so even though they took on lots of loans, bought up a bunch of shares, saw the shares go to the moon, the shares ultimately plummeted and they lost a lot of money. So as they were ruined, the people who lent them money were also ruined. At that time, the people who were involved in these were called trusts. They were kind of like shadow banks. So as the shadow banks were under question, people began to wonder if the commercial banks that lent the shadow banks, that lent the trust money, were also in trouble. And so everyone there began to worry that their banks might go under. Now, back then, there was no FDIC insurance, so insurance really meant having a really good pair of shoes and running there as fast as you can to get money out. Now, you can see here that you have a lot of people there trying to get money out. And in this context, again, just like Silicon Valley Bank, maybe the banks are well managed, maybe they have a lot of good assets, but they just don't have enough cash on hand. So they're not able to meet all these withdrawals immediately. At this time, there was no Federal Reserve, but there was this guy here. His name is J.P. Morgan. He was basically the towering figure in finance at the time. And so he called all his friends together, and this included people like Rockefeller, and it also included the United States government, and they put money together, and they basically deposited money in some of the weaker banks at that time. Now, the U.S. government drove up and deposited a princely sum of $25 million. That actually was a lot of money back then, but it was all in an effort to try to show the public that these banks have cash to meet your withdrawals. And so don't panic. You don't have to worry that your money is not safe. And that was successful in calming the panic. So in this case, we did not have a central bank, but we still had a lender of last resort, and that came from the private sector. But looking across the world, we also have other experiences where you can have lender of last resorts that don't come from a central bank. So the dollar is unique in that it's a global currency that's used throughout the world. Many times, foreign countries like to borrow in dollars because dollars are used widely and also because dollar markets are very liquid. Now, what I'm showing you here is for Southeast Asian countries, so Malaysia, Philippines, Thailand, Indonesia. So in the late 1990s, there was what's called the financial crisis in Southeast Asia, where at that time there was just a tremendous boom. So they had a fixed exchange rate to the US dollar, and they also had relatively high interest rates. So a lot of foreign investors poured money into Southeast Asia and rode the wave. And at that time, everyone was making money, everything was booming, but like all booms, it eventually busted. So as the boom faded, all these foreign investors, they tried to get their money out of the country. But when they're trying to get their money out of the country, they're selling the foreign currency and they're getting dollars. But the problem is that these countries don't have infinite amounts of dollars. Eventually, they were running low on dollars, and They tried to solve the problem by depreciating their currency, but that only created more panic. At the end of the day, these countries needed more dollars. They needed a lender of last resort to come and support them because they couldn't print dollars. So what did they do? Well, they cried for international help, and so you had the IMF leap in and give them tens of billions of dollars to try to tide them through, and that was really helpful in rescuing the foreign investors. But beyond that, it was not super successful. At the end of the day, though, they were helpless. The only thing they could do was beg the international community, and the international community emerged as a relatively ineffective, but still a lender of last resort. Looking across the world just more recently, so as I mentioned before, the US dollar is a currency that is used throughout the world. So in Europe, for example, if you're a bank and you have dollar liabilities and suddenly you have a lot of people asking you for your money back, what do? One thing you can do is you can actually indirectly borrow from the Fed. So the Fed, so European banks would borrow from their central bank, who then in turn borrows from the Federal Reserve. Ultimately, in the March 2020, when we had a global panic, you can see here that the Fed ended up lending hundreds of billions of dollars, that's the blue part here, central bank asset swaps, to foreign central banks as a way to act as lender of last resort to their banks, so foreign banks from our perspective, to meet their dollar needs. So they were not able to print their own dollars, so they ended up begging the Fed as their lender of last resort. So if you don't have a central bank, you ultimately still have a lender of last resort. It's just not your own central bank. It could be someone very wealthy, like JP Morgan. It could be an international organization like the IMF, or you could be begging foreign countries like the Fed for a swap line. Sometimes, of course, there's still, no matter where you go, there's still no lender of last resort, so what do you do as a bank? You're there, sitting there, a lot of people outside wanting your money back, but you just don't have the cash on hand. Well, when that happens, you really don't have any good options. What you could do is you could sell your assets to try to raise cash as best as you can, but when you do that, though, of course, if you fire sell assets, you don't get very good prices. So you could end up with losses that ultimately your bank holds, and so your bank could go bust. Or when you sell a whole bunch of assets, you can put downward pressure on the rest of the market and make other banks seem unsafe as well. So during the Great Depression, we actually did have a Federal Reserve at that time, but I think they were a bit more hands-off at the time. So during that time, we had several thousand banks fail. There was really no lender of last resort, and it ended up with a period where the banks failed, people who put money in the banks lost everything, and we had a few years of very, very poor economic growth. So all of this is to say that, the lender of last resort function is important and will be performed by someone, and if by any chance there isn't one, the outcomes have not been good. Okay, so the second thing that a central bank does today is basically set interest rates. Now, what would happen if the Fed were not setting interest rates today? We would still have interest rates. It would just be set indirectly by what other countries do. So we know this by just looking across the world. So here we have countries that are dollarized, and if you look at the interest rate in some countries who are dollarized, they basically move in line with the Fed. So, and to be clear, interest rates are, in part set by central banks, but also ultimately supply and demand. You can have things like regulation. You can have things like capital control, which limit whether or not a domestic investor can invest abroad or foreign investor can come in. So all these things impact how interest rates are set. But if you didn't have a central bank, you would still have interest rates. It would just be set by someone that you don't control or at least have any governance over. And even today, even looking at countries that are not dollarized, say the European Union, what happens in the US Treasury markets ultimately spills over to how interest rates are set throughout the world. It's as long as you have free flowing capital, it's an international market, subject to many forces, but it would still be set. You just wouldn't have any say in it. So the reason that the Fed is able, or any central bank is able to set interest rates is simply because they have a money printer. And I'll show this example as how the US does it. So the US, again, the Fed's target is a short-term interest rate that's overnight, but the Fed is able to control that because it's willing to borrow and lend at unlimited quantities at their administered rate. So today, let's say the Fed says interest rates cannot be lower than 5.5%. They're willing to borrow infinite amounts of money at 5.5%. So anyone who says, I would borrow at 5.4%, you would just go, no, I can lend at the Fed at 5.5%. And you can see that's this blue line here, so right-hand side. During the past 2 years, the Fed has been borrowing up to $2 trillion in the money markets, part of their effort to maintain control over interest rates so that they would not drop below where the Fed wants it to be. So on the upside, the reason that interest rates don't go above a certain level is because the Fed is willing to lend at that rate below. So I'm showing the Bank Term Funding Facility. If anyone wanted to borrow money, the Fed, and someone was offering a rate higher than what the Fed was offering, well, they would just go to the Fed instead. And so being able to borrow and lend at infinite quantities, whenever at rates that you set, you have control over interest rates. Basically, everything is a database question, and the Fed controls the database. But one thing about not having a central bank, though, is that there are some positive issues, and that when you don't have a central bank, there's less of a possibility of domestic mismanagement. So here you have the inflation numbers for Ecuador and El Salvador. That red line marks the time when they began to dollarize. And as you can see, the moment they started to dollarize, especially in the case of Ecuador, things got much more stable. Well, one of the reasons is that, again, if you have a central bank, you can print money, and sometimes that power can be abused. If you are a country that is maybe not super well managed, there's a temptation for a government to try to basically buy votes. When you don't have your own CB, you don't have that option. Your policy options are much more narrower, and so you basically can't abuse that. And so you take away that avenue towards inflation. But then again, that also opens up other avenues. For example, in this case, as you're pegged to the dollar, what if the dollar becomes mismanaged? And then, because through your peg, you import that mismanagement. And there is a good case that the US dollar is not being super well managed right now. But we'll talk about that first as a small update to how the dollar system is going. So first off, the dollar system is super, super strong. So over here on the left, this is from the IMF. This is the blue. This is the share of dollars in trade finance. The dollar is still the international currency of trade. If you are, let's say, as a Thai company trying to buy something from Mexico, more often than not, it's going to be in dollars. Everything in the world internationally is largely conducted in dollars. On the right-hand side, you can see this reflected in the foreign reserves that foreign countries hold. What that is basically a rainy day fund that foreign countries hold in case they happen to need foreign currency. And according to their own judgment, they hold a lot of dollars because, again, that's really the currency that their companies would need the most in case of emergency. So the dollar is still very much a dominant part of the financial system, notwithstanding many things that we read in the news. However, things are changing slightly. Now, there's some research here by a couple economists. This one is from done co-authored with someone from the Bank of International Settlements. They try to map out the world into different currency zones. The way they do this is they look at the world through a few major currencies and then look at individual countries and see how correlated their currencies are with each of the major currencies. In 1975, you can see here in blue, this is of course during the Cold War, the US at the height of its global influence. It was a dollar world. All these countries here in blue are part of what you could consider the dollar system. Now though, a few decades later, things look very different. Now, we still have a world that is very blue, but you also have these new centers of power emerging. Notably, more countries have their currency that seem to move in line with the RMB. So there is a change in the dollar system, and it is getting slightly weaker. Now, one way that the researchers go and try to break this down is that they go into the United Nations and find countries and see how they vote in the United Nations. What they did was they grouped countries that tended to vote in accordance with China together and grouped these guys as part of the China bloc and then looked into how they hold their currencies. Now, what they're seeing is that the China bloc, it really is moving a bit out of dollars and into things like gold. It's a very small move, but it's very discrete. So you can see China bloc here, share of gold reserves going higher, China being a big part of that on the right-hand side. Now, one of the things to note is that this is a very long process. During the Cold War, there was also a bifurcation of the global financial system, but it took place over many decades. If you actually overlay the timeline we are here compared to where we are back then, it's actually proceeding at the same pace. So this is something that could continue for decades. And it's really no surprise why the dollar system seems to be weakening a bit. The US is doing a lot of things that are making it unattractive to hold dollars. Now, as we all know, there is inflation, and that's the same thing as saying depreciation of the currency. So the way that this is done really is through massive fiscal spending, deficit spending. So when you are a government and you spend more than you take in taxes, you pay for it by printing debt, which in a sense is just money that pays interest. If I were to give you $1 million in US Treasuries, that's really just like giving you $1 million bill that pays interest. It's an obligation of the US government. You can go and you can borrow against it, you can sell it for spendable cash and so forth. It's not that different. They're dollars, basically. So if you have tremendous amounts of fiscal spending, and on the right-hand side is a projected fiscal deficit, it's historically very large and expected to go larger. This is from the Congressional Budget Office, by the way. So you are promising the world that you are going to continue to print more dollars, and that is not good for the currency. Secondly, there's also more and more political risk when it comes to this. So the US, as we all know, is sanctioning some Russian assets. So that's kind of like the bank saying that they're just going to take your money because they don't like you. If that's the case, you won't bank with them, right? And that's the same way that's happening throughout the world, where many countries are worried about political risk. What if I hold dollars? What if the US doesn't like me one day? Then I have to, at least just to be prudent, diversify a little bit. I can't have so much counterparty risk with the United States. Okay, now just some random thoughts as we go forth. So oftentimes the solution that people talk about is to have full reserve banking. Now, in that case, the banks don't so much as create money, in that they kind of just become huge versions of what we see on the right, safe deposit boxes. So you put money in and you take money out. The bank doesn't actually create money by making loans. Where does money come from then? The people who are proponents to this are basically saying the government would be the sole provider of money. So money would be created and allocated by the government, and then you could kind of pass it around like a token and maybe lend it to each other in a peer-to-peer way. But ultimately then, it's the government that decides who gets the money and how it's allocated. In a sense, it's very much like a command economy style, which could be very good if it's conducted well. We've seen cases where good industrial policy has led to great growth. A lot of times in China, you can think that massive industrialization was in part because of good government policy, but of course it's also vulnerable to political abuse, because if the government allocates money, oftentimes they would do it for the benefit of the politicians. And we also see large corruptions in countries that are more authoritarian. What about full reserve banking when you have commodity money? Well, again, you can't really have a full reserve system with commodity money, and it really doesn't exist anywhere because it doesn't really work. I mean, let's say that you were having commodity money, be it Bitcoin or something like that. What if, for example, you have tremendous amounts of technology improvements and suddenly the amounts of goods and services in the world increase a lot? Well, then you would get deflation, right? Is that desirable? Or what if you had tremendous population growth, tremendous demand for money, but then your commodity source of money doesn't increase in the same level, then of course you would have deflation. So there's a lot of volatility involved, and you would have very high interest rates as money doesn't increase, but population and demand does, or you could have low interest rates if you have technological miracle. It's a lot less management by the government, a lot more volatility, and so it hasn't really been a successful thing to do. Gold standard, another form of constraint, and as I understand, we'll have a much better talk of this later on. But gold standard, form of government constraint. You can have gold standards some degree of flexibility, as we can see. This is the price per ounce in gold in pound sterling over the past century. You have times when we have national emergencies and you can go off the gold standard. In times of war, that's during the Napoleonic War. Later on, it's towards the Second World War, where they did not come back. But the good thing is, of course, you have some degree of constraint, so you cannot have tremendous amounts of mismanagement from the fiscal authorities that we see today. But again, sometimes flexibility is needed, and you are still subject to various commodity shocks, like if you find something, discover a new gold mine, and so forth. So what I really mentioned that I really like about the reserve protocol is that it kind of combines the aspects of both banking and central banking, in that you can issue assets, you can issue money against assets like a commercial bank, but unlike a commercial bank, it's not redeemable for higher forms of money. So there's no run like you could have in a traditional bank system. The way that the commercial banks handle asset volatility is that they just kind of don't let you see what happens. So some assets don't have to be marked to market, and of course there's only periodic disclosures. So in a sense, you are asked to close your eyes and just trust the banks, but then I guess if you have a protocol, that could be managed better. But one thing I think that the commercial banks do well that I think would be worth thinking about going forward is the allocation of money. So Reserve has a really good way of issuing asset-backed money, and that's super important. But at the end of the day, though, it's also about how money is allocated. What if someone doesn't have assets and they would like to have money? Well, you can go to a commercial bank and they can create that money for you such that people who don't have assets can still be able to invest, still be able to go to school, get a loan, and so forth. Basically, the bank makes a judgment as to whether or not the borrower is worthy of having money, whether or not they repay the loan, whether or not the project is worthwhile. So being able to create money is one thing, but I think to be able to have a successful monetary system, it's also important to be able to have it to be allocated in a way. And that could still be done, I suppose, by lending, issuing tokens and then lending them. But then when you do that, you are also reintroducing many of the conventional risks that we see in the banking system, like credit and liquidity. So I would emphasize that being able to create money is super important, but having it allocated well is what makes money effective in creating an economy that has good growth, but also more equality. It's really hard to know whether or not money will be allocated well. Are you going to be giving it to someone who is going to spend it wisely? So it's a lot of work that the commercial banks do, a very qualitative judgment to say, is this person credit worthy? Is this project viable? If you have a monetary system, in addition to having the base layer there, having an idea of how it could be better distributed to be able to benefit everyone, even people who don't have assets to get tokens, I think is really important for its adoption. And that's all I've had for today, and I think we have a small discussion with Nevin now. Thanks so much.
All right, thank you for that, Joseph. Much appreciated. I took a few notes on questions that I have during the presentation. So let me start us off with a pretty simple, basic one. So you talked about how the bank equity holders are on the hook if a bank sort of creates a deposit, lends it out, and it doesn't come back. Could you just explain the mechanics of it, actually how that works? Like, at what point does the system, does the bank decide that somehow they have to take that value from equity holders, and how does that work?
Yeah, so what happens is that banks have like an income statement where they have losses and profits, and at the end of the day, if they have profits, that gets added up into their equity. Now, if they have losses, so let's say a loan doesn't repay, then again, you go through a process. It's delinquencies. They try to work it out, and at the end of the day, if that loan is not collectible, it gets written down. So on the asset side, that loan, let's say the loan is $100, you got a decline in $100 on the asset side, and on the liability side, that's the equity that decreases by $100. And the equity, you can think of that. It's also called capital, but so that's basically what the owners put up as a way to absorb potential losses and to share in the profits.
And so do the equity holders have to put up some sort of cash as collateral in advance to cover that, or?
Yeah, in the beginning when you start a business, yes, of course, you put up cash.
Yep.
Yeah,
yep.
exactly.
Okay. And so basically, but there's not enough collateral to cover all of the loans if they defaulted, right?
No.
There's just an assumption about a risk level that's tolerable.
Exactly right. So I think it depends on so in the current banking system, the amount of capital you have to hold is dependent on the size of the bank. So you could have, let's say, 15%, but for a large bank, but it'd be less for a smaller bank. It depends on a whole lot of things. So definitely not able to cover everything.
Okay, great. Thank you for that. And then I really liked your example about a case where private lenders of last resort still stepped in. But I'm curious, with the two examples you talked about, the world where the private lenders did step in and the situation with Silicon Valley Bank where the Fed stepped in. Let's say that the Fed, for whatever reason, had not stepped in, and maybe there just was no Fed, or somehow they just credibly signaled they would never step in. Do you think with a financial situation like what happened with Silicon Valley Bank, there would have been private lenders of last resort that would have stepped in, or would no one have had the incentive to do that? Like in that earlier story you told, were people stepping in out of the goodness of their hearts, or did JP Morgan see a profit opportunity? Is it something where, had there been no central bank, would the situation still have been sorted out, and who do you think would have stepped in?
So that's a really good question. So I would imagine back then, again, JP Morgan, many other people, they have skin in the game because they are part of the financial community. If there's contagion, they would stand to lose significantly as well. Now, moving forward to the example in Silicon Valley Bank, I think it's difficult at that time for a private party to step in simply because it happened so quickly. That being said, during the great financial crisis in 2008, we did have private investors step in. I believe Warren Buffett was one of them, and they did step in. They would tell you it's to save the country, and probably it is, but also they got some really, really good deals back then as well. So one of the ways that the central bank is, in this case, can be better than the private sector is that when you have these really fast events, they can act faster than anyone. And they have money printers, so they could definitely back up their words. Now, Silicon Valley Bank happened in a matter of a few days. Even if you had a lot of rich people that wanted to help, I'm not sure they would be able to coordinate quick enough to do this. And also, they would not have time to go through the books, the information, simply because banks are these huge, complicated businesses, right? The Fed doesn't actually care that much because they have broader policy concerns, preventing contagion. But I think the private sector, they're more self-interested in a bit, and they need more time because they have something to lose.
Yep, that makes sense. So I think that highlights an important question for us to think about is, we can't just say, private lenders would always step in to fulfill that function. Maybe sometimes they would, but maybe sometimes they wouldn't.
Right.
And you have to think about the economic consequences if they didn't. I want to talk briefly then about full reserve banking. So I have a question about that, but let's start by defining what that means in simple terms. So with a full reserve bank, I assume that means that, as a bank, I take in money as deposits, and I can only lend out that money that I've taken in. How would you define a full reserve bank?
I think of full reserve banking as if you take in cash, then you turn around and you put it in a safe, so that at any moment...
No lending at all.
Lending is possible, but what you would do is you would have something called a time deposit. So let's say that you're the bank. I put money with you, but I sign a contract not to take that money away for a year.
Okay.
Then, of course, you can just go lend it to someone else.
Okay.
But otherwise, I think of full reserve banking as if someone goes and asks who has a legal right to take their money back at the same time, the bank is able to meet that because it's all in the vault.
So to make an analogy to an account type that maybe many of us have, like a crypto exchange where you've deposited your tokens and you assume that they're being held for you, not lent to anybody. But you could choose to say, okay, these can be lent out, to other users, and maybe I'll earn some cut of the proceeds from that.
Right.
And that enables lending markets, but only on a voluntary basis for depositors who choose to engage in that lending.
Yes.
Okay. And so then, if with that system, with a full reserve approach like that, rather than a fractional reserve system, do you think that, this might be a really dumb question, but I'll just ask it anyway, would you still need a lender of last resort? Like, would the sorts of circumstances that arise that require a lender of last resort, would that just not happen? Or would you think that would still be roughly equally common if you had an entirely full reserve?
No, I don't think you'd need a lender of last resort.
Okay. Well, that's interesting. I would like to, that seems like an important question. We should be confident about that if we're thinking about a sort of crazy design for the world financial system. But it's an interesting idea that maybe you wouldn't need it in that scenario. But on the flip side, there's also the question of what would you do to the economy if you eliminated fractional reserve banking and didn't allow all those loans to easily flow into circulation from balances that were created from nothing, right? So that kind of raises the question of, let's say you had all these full reserve banks based on an asset-backed currency or based on like a government-issued, full reserve system. I guess the question would be, what would interest rates be, right? It's like if interest rates under the current system are low enough that all sorts of businesses can get loans and people can buy homes and so on, are there any references that are live today in countries today or historically that you think are worth studying to understand what would liquidity and interest rates look like in a world that had full reserve banking rather than fractional reserve banking?
So I have not studied this topic closely, so I can only speculate in that if you were to have full reserve banking, then as you mentioned, banks would have less elasticity to be able to expand the money supply, and that, all things equal, would necessarily have to raise the cost of money, right? Because you would have to be able to find someone else who's willing to part with their money, and sometimes, depending on supply and demand, that could be hard to find. You might be able to have to pay very high interest rates. Now, in a time of a panic, that could become really, really high, right? So it seems like you would make the financial system more fragile in a sense. But also, I would also frame it in a way, because I think of money as a social creation. When we have money, we want to be able to allocate it in a way that everyone has access to it, that's going to use it for good purposes, be it to go to school or to start a project or something like that. If you have a less elastic system, what about people who have great ideas, great potential? How are they going to get money and what price? And I think that becomes more difficult to allocate, and that's just not good for overall growth, and that's not good for, I think, social welfare.
Yep. No, I hear that. I'm really interested in thinking more deeply about, how would we study that? How would we forecast what the economic conditions would look like?
Right, it's a hard question.
Yeah.
It's a lot of qualitative judgment.
Thank you for sharing your perspective on it. Okay. You made a brief comment about how many people think that the dollar system might be mismanaged in some form or another. I'm curious for your perspective on, people talk about the ever-growing national debt, and they talk about the possibility that at some point we may be forced to monetize that debt. Could you talk about what does that mean? What does it mean to monetize debt? What possible things could happen that would force us to monetize that national debt? And if that happened, what would it really look like? To the extent that that's something you are comfortable speculating on.
So I think in the case of the US and in the modern financial system, I think it's more helpful to think about debt as a form of money, especially if you're talking about US debt. I mean, money is very liquid. It's very safe. It's something that that gives you purchasing power. No, that's a U.S. Treasury. Like if U.S. government gave you $1 million of treasuries, that's already very, very much money. Like you don't really have to monetize that. You can. What would happen is the Fed could buy it, and in extent of $1 million in treasuries, you can have $1 million deposit in your bank. That is more liquid, without doubt. But slightly so. If you were to give me the debt from Argentina, issuing that's not super money-like. But in the U.S., because debt is so money-like, it's so liquid and so widely accepted throughout the world, it's already money-like. You don't really need to monetize it. What I look at the tremendous debt situation as is simply just printing dollars. And that seems to be what's happening. Now, in the event that the markets do seize up and that there is less liquidity in the treasury market such that it becomes less money-like, there are always ways to monetize it, as you say. Looking throughout history, the classic responses are first, you can have the commercial banks buy it, and what that would mean is, of course, you would issue deposits backed by U.S. treasuries. That would be a form of monetization. And that is very common in countries that have weak sovereigns. Alternatively, you could always have the Fed buy it all, and that would be a sort of monetization. So Fed takes in debt as an asset and issues what ultimately becomes deposits in your commercial bank. So
okay, so let me say that back to you, make sure I understand. So if I get that right, it's like treasuries these days, because there's such high demand for them, they're very liquid, they're already sort of money-like.
yes.
But there could be some circumstance where for some reason the market stops wanting treasuries as much.
Right.
So, people stop being willing to lend money to the US government essentially. So it's like, okay, well, now there's all this debt that can't just be rolled over. And so then you're saying that, you could basically, the commercial banks could buy that debt and issue dollars that are sort of backed by it, or the Federal Reserve could do essentially the same thing.
Exactly.
Do you think that the commercial banks would want to do that, or would it be that some tool of monetary policy would force them to do that?
So I think the way that, just some history again, in the 1930s over there, back then the commercial banks 1940s, apologies, they basically, almost all their assets were in treasuries. And if you look across the world, let's say in peripheral Europe, on the balance sheet of banks, huge amounts of government treasuries, government debt. The way that this could work in the US is you just have to adjust the regulations to encourage banks to buy more treasuries. So banks are highly regulated, and they make a calculation when they make a loan or buy an asset, how that will affect their regulatory ratios. And you could easily tweak them such that you would make buying treasury debt more attractive. It doesn't have to be forced, but it could just be by adjusting the incentives.
Okay. And so if that happened, if a lot of those US government notes and bonds were held by banks, dollars were issued against them, what further consequences would come from that? Or is there any predictable consequence?
It would be very, okay. So I think my best guess is that this would have an inflationary impact. Obviously, you are increasing both, if you have dollars in the form of treasuries, at the very least, you get some 4 or 5% yield. That might impact whether or not you're willing to spend it or exchange that for goods and services. Now, if it's just a deposit at a bank, I think, first of all, that's more liquid. And also, I think deposit rates are quite low. So I think that would encourage people, basically would increase the money supply significantly and encourage people to go and look for alternatives. So I think that would be inflationary. And it could potentially weaken the dollar against other currencies as well. So it's not a good situation.
And so I guess that really then brings us back to the question of what sustains the demand to lend to the US government, and would anything ever change that or not?
So I've been looking into this. I think it's really surprising to me that the US government debt market is as strong as it is today. So the projections for the fiscal deficit are really bad and have really no indication of getting better. When I look into the statistics, the US Treasury publishes statistics as to net purchases. It seems like there's a lot of foreigners buying dollars actually over the past year. And I'm not quite sure why. Maybe the interest rates are unattractive, or maybe there's a lot of people who don't really fully grasp that perhaps the world is different than it was when they were growing up. I think we are in a place where there are big changes in how the monetary system is, and I think some people are a little bit faster than others, and a lot of them are in this community, but I don't expect that to always be the case, that we have this strong demand for US Treasuries.
What sort of facts could the world recognize that would cause a shift in that sentiment on a broad scale? Like what is it that you're looking at that's making you feel the shift that maybe those other dollar buyers are not seeing?
So we are seeing some shift, as we saw in the chart of Chinese holdings of treasuries. Some shift, not a lot, but some shift, and that's partially due to political risk. And I think so that's causing some shift. But I think what you would need to get for, I think, broader recognition is that you have to see the economic impacts of significant debt issuance, that is to say inflation becoming more of a sticky part of the economy. Now, I think there's a widespread perception that we're just going to go back to normal, but in the event that we don't, that inflation is just the depreciation of your currency against goods and services. In the event that people see that this, large fiscal spending leading to a permanent higher level of inflation, maybe 3%, I think that could really dent the demand for treasuries. But at the moment, inflation rates are heading lower towards 2%, so I don't think we have that awareness yet, but we could see that in the coming months.
Yep. Okay. Well, thank you. I appreciate your thoughts on that. Let's pass a mic around for any audience questions. Does anyone have any questions for Joseph? If so, you can raise your hand, and we have a handheld mic that'll be brought to you. I'll give people a moment to think of their questions.
Thanks. That was great. I was going to ask, you sort of mentioned, I think, on the asset-backed currency, like if you had a big technological boom or demographic boom, you'd have deflation, and that hasn't worked well. Could you talk through the mechanics of that, or maybe a historical analogy? I'm thinking is that William Jennings Bryan cross of gold? Why has that gone poorly in the past?
So from my read, let's say if money is a commodity-based, what controls the supply of commodities? That's oftentimes factors beyond your control. It could just simply be luck. You go to South America, you discover a ginormous silver mine, money supply goes to the moon, and then you have a lot of inflation, right? Is that preferable to having a system where you would actually have a group of people, not perfect, but at least having some degree of accountability to the public, some degree of policies, procedures, transparency, setting what the money supply would be, or that seems to be preferable to something where you can just suddenly have these accidental discoveries, which is what happened, and then you had inflation in Spain and in Europe during that time. So yeah, it does seem to be commodity booms could lead to these.
So I did have one more question written down. I resisted asking it, but it's related, so I'll say it, which is if you had an asset-backed currency that was backed by, say, just an index of roughly everything, such that then in times of demand for money, that would effectively just suck more of all of those assets into this index, right? It's like if the market goes and buys more money, that drives the sort of price of this asset above its, sort of backing par value or whatever. Arbitrageurs buy up all the assets, mint this, this currency and sell it on the market for a tiny spread. So basically it sort of tokenizes everything and sort of monetizes it. Do you think on that scale, because of the fact that you effectively can mint, or the market freely can mint new units of the currency, but it is sort of drawing up the liquidity of all the assets, is sort of the scale of all the assets big enough that would actually be a nice elastic way to manage the money supply? Or do you think that, no, actually those, all those assets are still not big enough, they're limited in supply, and so, demand for money actually goes up and down so much relative to all the asset values in the world that you would basically cause asset bubbles on the rest of the market by, having that demand for everything to be used as money? Does that make sense?
Gosh, if you had basically backed by tremendous amounts of assets, That's a hard question. Yeah, I don't know.
I get puzzled about this too. Yeah.
No,
All
that's
right,
a good question.
Something for
I
us
don't
to
know.
think more about. I think we have a question here in the front.
So when you're talking about inflation, sometimes it's confusing to know exactly what you mean or anybody talking about inflation. So on one hand, there's something like consumer prices, the CPI going up.
Yep.
In another way, you could say there's the monetary base, the amount of currency units is going up, that's inflating. In these two kinds of inflations, are any one of them more or less relevant to that comment that you said earlier about the debt and inflationary pressures?
So I think of inflation as basically the purchasing power of the currency as measured by goods and services. And you make a very good point. It's very difficult to measure that since there's millions of different goods and services, each thing have their different prices. How do you weigh that into an index? There's no good way to do that. So you just go by CPI or PC or something like that. So I think of that as the measure of inflation. Now, things like the monetary base or money supply, I don't really think of that as any measure of the value of a currency. I mean, that doesn't really affect your value of a currency, right? Because it's the value of your currency is what you can purchase with it. Now, let's say that I printed $1 trillion worth of $100 bills. I lock it in this room and I swim in it in Scrooge McDuck style, but I never spend it. Does that really impact your purchasing power? It's as if I never had it. So I look to things like CPI.
Right behind you.
Yeah, so this question is a little bit unrelated to some things we've talked about. I'm just curious to get your thoughts. There's a book, it was written and published by Edward Chancellor, I think, Price of Time, like a year ago. Druckenmiller also promoted the book. And the core of its argument is that the interest rates that the Fed has maintained have been below what Chancellor would argue is the natural rate of interest, which should be much higher. And this has been detrimental to economic growth by, to your point earlier, slowing down the rate at which capital goes to the people who can use it the best. I'm curious to get your thoughts on basically that argument, and where do you agree with the argument, and if so, why or why not?
So I used to intern for Ed once upon a time, and I did a podcast with him about his book about a year ago. It was a good book. Great. Ed is really smart. So I don't really buy the view of there as being a natural rate of interest. I think of economic phenomena as social phenomenon that changes throughout time. So thinking of things as having a fixed value, that's physics thinking. I think that's very common in economics, but I don't think that's the right way to look at it because, in social phenomenon, things change over time. Relationships change, technology changes, people's, say, risk tolerance varies by culture to culture. So I don't think that makes sense. Whether or not interest rates were too low and that contributed to poor growth, I don't think so. I think that when you're thinking about, when I think about money, it's not so much that the price of money, interest rates, but also things like allocation and quantity, and that's more of the job of the fiscal government, the elected government, stimmy checks and so forth. I think that's the part that was not done well. I think the monetary authorities over the past 10 years did the best that they could. I don't think they were responsible for the poor, slow growth after the great financial crises.
All right, and we'll do one last question we have here in the front.
Thanks. So I couldn't help but notice in the monetary regime chart, the RMB block and the more recent graph, to me, it just looked like commodity exporting countries like Russia, Brazil, South Africa, Australia. So would it be incorrect to say that in some parts of the world, they're organically moving towards commodity-backed currency, or is something else going on? And if this is the case, does it make those regions more susceptible, or I guess a greater share of the world more susceptible to the commodity boom-bust cycle?
I think it's more about the stronger business links as you described. So Australia, strong ties with China, basically digging up rocks and sending it to them. Same for Russia. So maybe they are moving closer in more of an economic bloc, and maybe that's reflected in their currencies. So, and if you are an economic bloc that's heavily impact heavily tied to commodity cycles. And yeah, I think that's probably more volatile. But it seems to be China, the ups and downs of China dragging the commodity exporters with them.
All right. Thank you very much,
Thanks,
Joseph.
Evan.
Really appreciate it.